Welcome in to the recorded on Monday, February 12th, 2024, airing on Monday, February 12th, 2024, CBG Podcast. Hope everybody's having a great day. Excuse me, I just got done live streaming all in the charts, talking about some exciting times in the crypto markets with Bitcoin topping out, or not topping out, but blowing past $50,000 today. It looks like we want to start heading towards $52,000 and above if you don't have a percentage of your net worth in cryptocurrencies. I've been saying for years you don't even have to invest that much, but if you at least don't have, say, 3% of your net worth in crypto, like, what are you even doing? I've been shouting that from the rooftops since 2000 and practically 18. So good to see Juan in here. Oof, let's fucking go. Rory, good to see you in here. But of course, for the CBG podcast, we're doing things differently here. We're not going to be talking about charts at all. You know, the main topic of conversation that I did want to talk about for today surrounds interest rates. And I think it's really important for everyone here to have a really firm grasp on why interest rates matter so much and how very much there's a domino effect that takes place with the changing of interest rates that essentially are dictated to us. So there's somebody sort of pulling the strings in terms of where interest rates should be, and perhaps that's a conversation for another day in terms of why, but that is the way our economy works. And so there are certain positive and negative consequences. People often, it's funny, when they hear the word consequence, they automatically assume that's a negative thing. That's not true. Consequence, DT, good to see you in the house. Have your cup of cafe. People, when they automatically hear the word consequence, they think that it has a negative connotation associated with it. It's not true. There are positive consequences and negative consequences. So having interest rates high or low, there are both positive and negative consequences. So that's really what I wanted to talk to today. And I sort of set the stage for this conversation. By the way, I wish you could see, I wish you could get a feel for the past hour and a half for me. So I raced to live stream all in the charts. Behind the scenes, I'm getting dinner started. I'm going to have to run out there and stop my salmon from cooking at some point. And now I'm out here doing the live stream for CBG Podcast. And after this is done, I'm going to go eat dinner. So I am multitasking. I do not have anyone here to help me out making dinner. I'm doing this all myself. I'm an independent, strong individual. Thank you very much. But, I sort of set the stage for this the other day, the last CBG podcast. I was trying to give a broad overview of a lot of different topics I wanted to cover. I thought I went back and critiqued most of my podcasts because I routinely do that and listen to myself. Not as structured and formalized as I would have liked in a presentation. But the thing that I realize in coming out and doing these podcasts, especially right now with the way my life is set up, I quite frankly don't have as much time as I would like to put into a presentation like this, really, because that's what it is, in a discussion. At some point, I have to do the best job I can and draw a line in the sand and either come out here and present on it or not, And at the end of the day, I always want to feel good about the material I put out there, but you also have to draw a line in the sand and understand that I can't get perfection. You're never going to have perfection, but especially at this stage of my life, still working full-time and trying to balance things, like I'm not going to be able to come out here and in many ways have the presentation the way I want it to be, but I'll put together everything in a sensible manner as much as possible. And by the way, this is very engaging. So even if I'm not looking at your comments at the moment, it doesn't mean I'm not going to get back to you. I just want to sort of get my thoughts out as they're coming to me here and as I have jotted down in my notes. And then time permitting, I can certainly make this as engaging as possible and answer any questions or see what thoughts you guys have. So, at the heart of the matter here, and what I tried to hit on in the last podcast, is what a lot of people really have no fundamental understanding of, and it really wasn't that long ago, is, roughly 50 years ago, we went to a pure fiat monetary standard. And a fiat means by government decree. So essentially what happened was the dollar went off a fixed supply. And the government at will, this is the easiest way. We don't need to go into technicals here, okay? The government at will can print more currency into existence. And what that does, if you think about it, it would be like you or I going into our spare bedroom and printing money when we needed it, right? The government justifies an exorbitant amount of spending on things that it does so that political parties can remain in power. Let's call a spade a spade. And so at will, when they don't have enough currency to spend, they just print it into existence. They either, there's only two ways for them to get the funds that they need. They either tax you or I, okay, they tax us, and they collect money that way, modern slavery, or they print it into existence, which in its sense is taxation because you and I pay through it through inflation. Okay, if you devalue your currency, if you, and this is the key point I was hitting on from before, if you increase dramatically the supply of your currency, it devalues it. And so that's really at the heart of the matter here. And so you have interest rates, and depending where interest rates are at, it can either result in curbing spending, okay? By having higher levels of interest rates, you can either curb the amount of spending taking place and you curb the amount of dollar bills that are going into the monetary supply to reduce inflation. So you're cutting down on the supply of the currency that's in circulation. So you're curbing inflation. Versus when you have really low interest rates, what it does is it encourages spending, increases the amount of dollar bills that are in circulation, and results in higher levels of inflation. That's really, in generalities, what's going on. And so the first thing that I wanted to do is I wanted to spend a little bit of time talking about the consumer and how the consumer has been conditioned over time and how there is a fundamental problem that exists between the consumer and the relationship they have with both currency or money, the problem which exists there, as well as interest rates. Now, I don't know if you've noticed this, but it's something that I've actually been tweeting and talking about and laughing about on some of my live streams that I've done when I've talked about crypto. I have found it absolutely hysterical that when I do an Instacart order or I go on Amazon and I make a purchase there is always this line that comes up from a firm for buy now, pay later. You just purchased $15 of Amazon, whatever. Do you want to buy now and pay later? Like, what the fuck? Like, if you can't afford to pay for $15 today, probably shouldn't be making that purchase, right? Way back in the day, I don't know if you guys remember this, but there was something called layaway, if you've ever heard of that. Layaway. I still remember I had an ex-girlfriend way back in the day, and she purchased an item through, where was it? I don't know where it was at. But she purchased I think it was a bed frame through layaway. And the idea was, hey, we're going to hold this aside for you. Give us you can't afford it today, but give us the payments over the next several months. And once you pay it off, you can have it. Seems pretty sensible, right? We'll hold it for you. Just make the payments every month, and it's yours. Well, now what we've done to encourage increased levels of spending that people can't, quite frankly, afford is we have this thing called buy now, pay later, where you can run up all sorts of essential debt levels, not pay for it today, and pay it over an extended period of time at zero interest. Now, if you pay it at zero interest, you're good to go. But if you start missing payments and you go over the threshold of the stipulated term to which you have to pay it back, you pay an exorbitant amount of interest, over 20%. Give me 1 second. Okay, so the thing I really want to hit on here is that this program is encouraging people to pay for things that they can't afford. There's a common theme here I really want you to keep in mind, that I'm going to tie everything together here. So the way that consumers are being conditioned, and you have to especially think of a younger generation. Again, I'm in my young 40s. It's kind of painful to say out loud, but it's the truth. I'm 42. I was born in 1982. But if you think about a lot of the younger generation that's in their 20s or even young 30s, they're being conditioned in a way to spend money that they don't have. Credit cards already do that, right? With credit cards, you have the ability to buy a lot of things that you essentially can't afford, right? Everybody has a credit limit. You could run up that credit limit and every month not pay off your credit card bill and essentially on a monthly basis be paying for things that you really can't afford on a monthly basis. You could rack up a huge credit card monthly overcharge. You could basically rack up a lot of credit card debt, right? Credit cards really were the advent of this. Now, I'm somebody who, and hopefully everyone here listening is, I'm someone who goes in every month and pays off his credit card bill in full. There's just no question. You pay the thing in full. But as this chart is telling you, and this is something, if you've been on this channel for a long time, this is something that I spoke to very early on in my content back in 2019. It was either 19 or 20 if you've been here that long. Might have been 2020. But this is 1999 to present, and it's showing you the level of outstanding credit card debt for all of us in the United States. This is personal credit card debt levels, 1999 to present. This is 2008 to present. So a couple takeaways here. One, this trajectory here is unsustainable. Unsustainable. Number two, even over the great financial crisis of 2008, look at how much higher we are in credit card debt. Now, what this tells to me what this speaks to are two things. One, people have an addiction issue. I very much relate it to heroin. People are putting themselves in financial positions where they are unsustainably paying for things that they can't afford. I have gotten into conversations with people who will remain unnamed where I try to impress upon said individual that money in, money out. If you have credit card debt, what that means is you don't have enough money coming in. You have more money going out than money coming in. So the solution is you either have to stop spending so you're not having as much money going out, or you have to bring more money in to cover your expenses. Like, it's really not that hard. It's black and white. It's why I love math, okay? So the first issue here is that keep in mind how consumers are being conditioned. They're being conditioned. You can buy now, pay later. Go ahead, buy now. Live the American dream. Buy now, pay later. Credit card debt's being run up. There's clearly a problem here. The other issue, though, is that a lot of people are putting money balances on their buy now, pay later, as well as their credit card balances for daily needs, things they just need. If you think about the inflation numbers being reported, and I said to you that inflation levels right now are just over 2%, okay? Anyone who doesn't follow these things and understand how inflation is actually being reported and how underreported it is, but it's just the number that the Federal Reserve relies on to communicate whatever messaging they want, you would think I'm full of shit. Because the two most predominant things in your life, food and energy, are up 5, 10, 15, 20+%. That's what you're feeling, okay? So part of the issue here, if you actually dig behind the numbers, part of the reason these credit card balances are increasing at such an alarming rate and buy now, pay later is such a big deal, people are buying everyday needs like groceries on these things, and they can't afford their monthly bills. If you look at the jobs reports, conversation for a different day, Full-time jobs are down. Part-time jobs are up. People working multiple full-time jobs is up. That should be very alarming to you. These are things that the Federal Reserve does not speak about. Okay? This paints a very alarming picture of society within the United States. Okay? For a multitude of reasons. No person should have to work 2 full-time jobs to afford everyday life. Okay? So many people are giving up and dropping out of the workforce that unemployment rates would be much higher than what's being reported right now. But again, we don't talk about that. But the underlying issue here is that the consumer themselves are being conditioned in a way. There's kind of a multitude of things going on here. I guess first off, probably what I should have started with, which I led last podcast off with, is this chart. There is an entire generation that was born into 0% interest rates. They were born into this right here. If you're not looking at the screen, I'm showing where the federal funds rate was. From 2009 through 2016, the federal funds rate was essentially 0. It made it very cheap to borrow money. We had an uptick to 2.25%, almost 2.5% into 2019. Then we plummeted down to 0 again in 2020, going into the largest historic rate increase that has ever taken place in modern era. So the first thing is consumers are being conditioned that money is cheap to borrow. 0% interest rates is what people are conditioned to. Secondly, people are spending much more than they're bringing in, partly because there's a heroin addict issue, an addiction to spending in this country and truly buying things that we don't need, as they're not necessities. There's a difference between things you'd like to get and then a necessity. I can't tell you how many challenging conversations I've had with people where I've tried to say, you might want this, but it's not a necessity. So if you have $5,000 of credit card debt, you might want to pay the $5,000 of credit card debt off before you start buying X, Y, and Z. Okay? So there's certainly an issue in the country where people feel the need to spend things on money that they can't afford, but also people can't afford their daily needs due to inflation, which is this issue. Third, it doesn't help when you have loan agencies out there, financial institutions that are willing to exercise buy now, pay later schemes where they're making a ton of money off of to people with low credit ratings who can't afford their daily needs. Again, putting people in very desperate situations where they're taking on a monumental amount of debt. Think about another thing that I have jotted down here. Think about student loan forgiveness. How much of a joke it is, and we're not going to get into this in the details, how much of a joke it is that, again, to win political votes, you have the president and government officials coming out and promising students that they don't need to make their student loan payments. And now we, the taxpayers, need to foot the bill. It's a fucking joke. And now what has happened, if you actually look at the numbers, now that has gone away and students are required to be paying their student loans, you see that a lot of people with that student loan debt are not making their payments. They've been conditioned that they could go to college for free. And now all of a sudden, think about this, really think about this. During the beer virus, they're in a situation where they're getting stimulus checks, they're working from home, they're getting free money sent to them in the mail, they don't have to pay on the student loan, maybe they get a brand new car, and now they're in a situation where a lot of companies are calling them to come back in the office. Maybe they moved and they have to move closer back to work. They're driving and commuting into work, which is going to be a gas expense. Now all of a sudden they have a $700, $900, $1,000 student loan payment. Okay? That in itself supersedes what their car payment is. They can't afford their car. So now they can't afford their car. They're trying to get rid of their car. That looks hard. You can't just give a car back. that puts a huge ding on your credit report. So you've been conditioned for years to not pay your student loans, and now all of a sudden you have to. Something's got to give, right? You haven't been financially disciplined enough to save and spend prudently. You've been undisciplined with your finances, and now you're in a situation where you thought that you never have to pay for your student loans again, but the government has lied to you and been disingenuous to win political votes, and now you have a student loan payment. Now, the other thing that high interest rates does, okay, we're right now at 5.5 roughly. Again, we spoke about this last time, and we're not going to go into this again. But again, this is not high. The rates we're at right now are not high relative to historical times if you go back to the 50s. But it's very high within the past 20, 30 years, okay? And we increased at such a sharp rate. What these higher interest rates do is it makes it very difficult for the consumer to go out and want to purchase a home with higher mortgage rates. It also, if you look at car loans, go on and Google and check out what the average car payment is and what the average interest rate is on a car loan. I remember, people will joke with me, and it's fine. It's deserved, okay? I've talked about getting a new car for years, and I've never pulled the trigger, okay? If you want to fault me for anything when it comes to finances, fault me for being gun-shy on pulling the trigger on making an expensive purchase. That you can fault me for. But I'm very prudent with my finances. And, I remember when I was several years ago, I was looking into what a car loan would be if I wanted to go that route and not buy a car, but actually take out a loan. And I remember, based on my credit score, I have a really good credit score. I remember the loan rates being, 3.5%. Try getting a car loan rate that's under 7%. Okay? So those loan rates have more than doubled. If you have a great credit score. But that puts a lot of constraint on a consumer that's already feeling the pinch from inflation figures that don't map up to what the Fed is saying. It's comical when they want to exclude food and energy prices. Food and energy should be at the heart of the discussion for inflation. So you have a consumer, if you read the jobs reports, that is increasingly moving into full-time positions. You have consumers who are dropping out of the workforce looking for jobs and on unemployment. You have consumers who are not able to afford their daily needs and have a spending addiction problem, which is leading to credit card debt levels increasing. Buy now, pay later, we call it BNPL, buy now, pay later. So if I say BNPL for short. BNPL balance is increasing dramatically for consumers. So if they're feeling all this pinch and student loan payments are now needing to be paid, how in the hell are they going to go out into the real estate market and afford mortgage rates where they're at and car loan payments where they're at? So the consumer, especially the undisciplined consumer, is really, really in a tough situation. You also have a lot of people, from what I was reading, that put themselves in a really tough situation. Again, a lot of purchasing decisions that were made when interest rates were really low, never thinking through the ramifications, and we're going to get into this with banks, never fully thinking through the ramifications of rising interest rates and what that could mean and why would interest rates rise. You have people who took out mortgages and homes that they really couldn't afford. They could barely afford it when they took it out. They locked in a real low interest rate. Well, what happens when all the costs around you are increasing, and as a result, your HOA monthly payments are going up, your taxes are going up? How in the hell are you going to be able to afford your mortgage today if you barely could get by a couple years ago? So you're going to have a lot of homes hitting the market for a variety of reasons, which should help to push down prices within real estate. Again, conversation for another day. But the consumer is really feeling the pinch, and unfortunately, they have a very strong recency bias that once interest rates come down, you can see when interest rates came down here, why did they come down? Because there was a financial crisis and they came down very sharply. When the Fed attempted to increase interest rates here, why did they come down? Because of a financial crisis, and they came down sharply. So the consumer is conditioned right now to believe that interest rates, they're actually cheering on the current economic conditions because they believe that the Federal Reserve is going to come out here and decrease interest rates in March, which I don't think that the Federal Reserve is going to do, but they think the Federal Reserve is going to come out here and significantly decrease interest rates this year, that we're going to drop from 5.5%, and within a few months we'll be down to 2% and 0%. That's their expectation, okay? Because that is what the Federal Reserve has done in the past. Now, if you listen to the words of Federal Chairman Powell, you would believe that that would not be the case, and they'll be very prudent and slow, and there'll be slow interest rate decreases downward. But I want to ask you a question. And this ties into the consumer feeling that everything is going to be la-di-da awesome once the Federal Reserve drops interest rates. Why would the Federal Reserve drop interest rates? Why? Do you think they're going to do it because we're at historically high levels and they need to ease the pinch that everyone is feeling, and they want to encourage that money to come back into the system, which could result in higher inflation? They want to encourage spending by the consumer, and it's gotten too tight and too restrictive? No. History would suggest to you the prior two occurrences in particular, if we look at this, okay? And I believe very much what Raoul Pal has said, that we've entered a new monetary era beginning in this time period back here, which is part of the everything code, and that's conversation for another day. But beginning back here, the whole reason that the Federal Reserve dropped rates at an alarmingly fast pace was because there was a disaster brewing within the economy. And I believe that is the reason that the Federal Reserve will ultimately drop interest rates. Now, I want you to think about this for a moment. If a corporation has high interest rate expenses, okay, if their interest rate expenses are increasing, okay, what can they do? And we're going to circle back to this. What would a company do? What would an organization, like you work for a company and their interest rate expenses are increasing? What can they do to offset that interest rate expense? Well, they could raise prices. Well, if they raise prices, that's kind of difficult, right? Especially depending, I'm going to stand up here. Especially depending what sector of the industry you're in, because I just said to you guys, inflation's been brutal in core spending. So if people are already feeling the pinch and prices are real high on things, how in the hell are corporations going to raise prices? There'd probably be a negative backlash to that, and the company might struggle to sell whatever its product is if they raise prices. So what else could they do to offset interest expenses? They could lay off. The greatest expense to any organization is overhead. And overhead means you and I. Layoffs. Okay? Hate to say ding, ding, ding on that, but so let's kind of bring this together. Where am I going with this? Well, if you go back in time here to 2023, in March of 2023, Silicon Valley Bank failed. In March of 2023, a couple days later, Signature Bank failed. By the way, Silicon Valley Bank was the second largest bank failure in U.S. history. It doesn't get enough coverage. Then in May of last year, First Republic failed. Then in July of last year, Heartland Tri-State failed. And then in November of 23, Citizens Bank failed. Now, I don't know the intricacies of all these bank failures, but there's a couple things to highlight. I do understand Silicon Valley Bank. Why did I'm going to bring this back to interest rate expenses and why this means layoffs, okay? Why did Silicon Valley Bank fail? Well, in generalities, what they did is they took out a lot of maturity risk, not interest rate risk, but maturity risk. They purchased a lot of bonds with long dated maturities. And really what you need to understand from that, from a layman's perspective, is they were led to believe, based on the Federal Reserve's actions and words, that interest rates were going to be very low for an extended period of time. And so what they did is they purchased some bonds with long duration risk because they could earn a higher yield, a higher interest rate on those long duration bonds versus purchasing short duration bonds. And the reason they did that again was they said, well, as long as interest rates don't dramatically increase, it's going to be good for us. Now, there's an inverse relationship between that bond rate and the interest rate. So if interest rates, at the time they purchased these bonds, interest rates were zero. So if interest rates started to drastically increase, the value of their bonds would go down, okay? And that's what happened. So as the Federal Reserve started to increase interest rates and do what they said they wouldn't do, because they saw inflation was spiraling out of control because we printed the most money into existence in human history. That is the main reason, okay? Once they started doing that, what happened with Silicon Valley Bank was they started to have unrealized losses on their books. This gets into technicalities, but from an accounting standard, even though they were in a loss situation on those bonds that they purchased as interest rates increased, because they didn't need to sell the bond, they didn't have to realize it from an accounting perspective. So they were unrealized losses. Well, a lot of financial investors saw this, and they started transferring funds from Silicon Valley Bank to bigger banks. And as that started, word got out, and that started to increase that, Silicon Valley has all these unrealized losses because the Federal Reserve has increased interest rates, and it has to do with all these bonds they purchased with these long durations, assuming that they wouldn't, the Federal Reserve wouldn't be increasing rates. Well, what that did is it resulted in Silicon Valley needing to sell the bonds, okay? Now they turn into a realized loss. So they had to sell these bonds at a loss. And so it just became this self-fulfilling prophecy that they eventually, they failed. And the government came and bailed out the consumer. Consumers were only FDIC insured up to $250,000, but the government came in and bailed out the consumers. I guess that's a conversation for another day. And I don't know the history behind all these other banks, but these other banks failed, right? So you got a lot of bank failures going on. And I said on Twitter, on X, this is just the beginning. This is just the beginning. This is not over. Now the risk, and this is going to bring it home to what I was talking about earlier. Now the risk, so much so based on what I'm learning, and again, this is just based on information that, I learn in my spare time, right? I'm not an expert. I professed that on my last podcast. I'm just a guy who loves numbers and analytics and found a passion in a lot of this economy stuff, right? And I'm learning as much as I can, and it's a journey for me and will continue to be. But based on my understanding, the next huge concern in the banking industry has to do with something called the wall of maturity. Now, one of the things that I spoke to recently or tweeted out was that there's apparently a lot of cyclical timing that takes place around March and September in the financial markets. If you read about a lot of bank failures, if you read a lot like when Lehman failed, you're reading about a lot of these things occurring in either March or September. Specifics to get into another day because I need to get a better handle on that. But as it relates to this coming March, okay, which is next month, there's something called the wall of maturity. And essentially what that is it's a time period under which a lot of companies need to refinance leases on real estate, on commercial real estate. So what's the problem with that? What's the big deal if some companies have to refinance lease obligations on commercial real estate? What's the big fucking deal? Well, the big fucking deal is when they originally financed these things, the interest rates were like 0. Okay? What are interest rates right now? 5.5%. So you have a lot of companies that are going to need to refinance lease obligations much, 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 much higher. And the only solution that's going to save a lot of these companies is for the Federal Reserve to come in and drastically reduce interest rates. I'm not talking about the Federal Reserve coming in and reducing interest rates by 0.25% or 0.5%. No, literally taking interest rates down to 0. And there is proof that a lot of people are assuming that the Federal Reserve is going to do this. And if they don't, what does that actually mean? Well, there's going to be a lot of companies that take a huge hit on real estate when they refinance. This gets back to my interest expense increase comment. What would happen if your company had to refinance its commercial real estate lease obligation, and as a result, because interest rates are much higher today than they were several years ago, how are they going to offset that? They can't absorb the loss. They need to offset that increase in expense with something. Can they increase their prices? Consumers are feeling the pinch. They can't raise prices, guys. The only way to offset that materially is layoffs. So, based on what I have been studying, this event that is to take place in March, which really doesn't get realized from my understanding until several months later. It's not like once March hits, shit hits the fan. That's not it. Once March hits, it's several months after once this starts to play out. But what's going to happen is you're going to have a lot of commercial real estate being refinanced at higher interest rates that can't be afforded. And the only way a lot of companies, most companies, are going to be able to, I hesitate to say most, I don't have the statistics on that. The only way that a lot of companies are going to be able to afford that increase in interest expense is to decrease workforce, decrease overhead. And as a result, you're going to see a big uptick in layoffs. And if you think we haven't been in a recessionary environment already, we're going to, in my opinion, see a pretty rough recessionary environment, if not by the end of this year, by 2025. Let me get into the comments here. I want to make sure people don't have questions or comments. All right, a lot of good comments here. Let's see what we got. No TA questions. Oh man, DT, your kids are learning something. This is awesome. They're going to be so much more better prepared in life. This is good to hear. What's up, Juan J. Jep Rocks? Yeah, taxation is legal theft. Guys, I don't mean to be. I'm not a. What is the word? I'm losing my train of thought. What is the word? I'm not a anarchist here. Okay. I believe that we should have taxes to pay for things, but I believe those taxes should be in a controlled manner, directed in the right way, and operated within a government that is disciplined within its control. We haven't even gotten into that aspect. I want to get back to the government and interest rates, actually. That reminds me. You are correct, J-Pox. The banking system about the interest rates, if you deposit your money to them, they can only give you a fraction of the interest rate, like a max of 2, but if you want to borrow, it's high. Correct. Kathleen, welcome in. Oof, I'm glad you're enjoying the podcast. Juan, you get tax-free from breathing. That's rough, my friend. Let's get back to the government for a second, because there is a positive correlation that exists between the government and the consumer, and that has to do with the spending addiction. So I spent a lot of time talking about, I think there is a fundamental problem with the consumer. And it's a double-edged sword, because the consumer over time has been conditioned to be undisciplined with their finances, whether it's student loan forgiveness, racking up credit card debt, or having the ability to use buy now, pay later. We could go on unemployment welfare checks as well, people that don't bother to look for jobs. But, they've been conditioned, and now they're in a situation where they're pinched based on inflation, and they're really, most people are hurting out there big time, okay? Well, let's look at the government for a second. What happens when interest rates are at much higher levels today than they've historically been in the past 20, 25 years? What actually is happening? Well, the government has debt as well. The government has spent so much more money than they've had. We are at, 34 trillion? Is it 34 trillion? Let me get the number here. Let me get the debt calculator, debt clock. I'll pull this up for you guys. If you haven't seen this before, you should check this. The U.S. government debt clock. Yes, U.S. national debt clock. I think this is it. This is it. Oh, this is awesome. If you haven't seen this before, it's really, really horrifically bad. This is the U.S. debt clock. If you haven't seen this before, go to this website right here, U.S. debt clock. As you can see, when I really first came to be familiar with this site. But let's not overcomplicate this, guys. What is this? What is any debt? If I told you that the consumer, we look at this chart here, and I said that the consumer is more indebted today with just credit card. These are just credit card balances. If the consumer is in more debt today than they ever have been in existence, what does that actually mean? They've spent so much more than they've brought in, right? Well, there's a positive correlation here. These are the highest debt levels the government has ever had. Okay, that's not a voice change. That's my throat still not being where it needs to be. The government has spent an exorbitant amount of money more than it has brought in. There are ramifications for this. There are only so many ways that the government can pay for this debt. Number one is taxation. They can increase taxes. You can paint a pig as many times as you want. Put so many different. A pig is a pig, all right? They can pay for this shit through taxes. But the other way that they pay for, you know how the other way they pay for this? They issue debt. They pay for the interest. The interest expense has gotten so high on the debt because there's an interest expense associated with the national debt of 34 trillion that is directly tied to the interest rate. All this stuff is tied to interest rates, okay? The government doesn't get away with it. If the government's debt level is at 34 trillion, they have an interest expense that is due every month. And the only way that they can afford to pay for that interest expense is to issue more debt. Isn't this mind-boggling to you? So the interest rates at current levels are literally unsustainable because the government can't afford to pay for its interest expense. Everyone, are things starting to click? The consumer can't afford their monthly bills because of inflation and things have run rampant, okay? And interest rates are super high, so they can't go out and buy a home or buy a car or, credit card, rates are out of control. But they're running up their credit card bills and their buy now, pay later because they can't afford shit that they need to buy every day. And they've been conditioned that the government's going to bail them out. They don't need to pay for student loans. They can run up the debt. They're heroin addicts. The average. I live in South Florida, guys. I live in South Florida. I see the materialism down here. There's nothing that crawls under my skin more than the person who drives around in a Porsche and lives in a fucking beater apartment because they need to show other people, they need to prove themselves to other people. It sickens me. It's an illness. So you have people that have a serious spending issue, and it's very evident by here, but this is a combination. This is the best chart you could look at. It's a combination of they can't afford it because inflation is so high, because the government has printed an exorbitant amount of money, okay, which has caused rampant inflation and for everything to cost more. That has resulted in consumers not being able to pay for things on top of having a spending issue to begin with. But now the government, because they have increased they have inflated the money supply, and they're spending money on things that they can't afford. We're sending billions of dollars to Ukraine. Why in the fuck are we still spending $90 billion on Ukraine? I don't understand. But this is what they do. We need to accept this. So they're spending money on things that they can't afford. And as a result, they're running this number up, this national debt number up. And as a result, because interest rates are so high, and the reason interest rates are so high is because inflation is so high. The Federal Reserve was increasing interest rates to curb inflation. You see how much of a losing battle this is? The U.S. government printed so much money, it ramped up inflation to spend money on things they couldn't afford, to give it out haphazardly to people in forms of stimulus checks. That resulted in rampant inflation. Now, to cool off inflation, we increased interest rates to an exorbitant level at the most historic rise in rates that we've ever seen in history. That rise in interest rates has pinched the consumer and resulted in the U.S. government being unable to pay their interest expense without issuing even more debt. So what this results in is the absolute need. The Federal Reserve is in such a pinch right now. If they don't decrease interest rates at an alarming rate, you're going to have more bank failures with the commercial real estate issue. You're going to have consumers that are increasingly unable to afford anything. And you're going to have a government that is literally going to default on its debt because it can't afford the interest expense. So then what you're going to have to do is you're going to have to decrease interest rates. And you're going to have to get us back to near zero. That is what will happen. That is what I absolutely believe will happen. Else it's going to be... Because think about it this way. Most simplistically, the Federal Reserve, we as a nation have only two choices, and they're shitty choices. We're either going to default on this debt and have an astronomical collapse, okay, the likes of which we haven't seen in 100 years, okay, or we're going to print more money. We're going to print more money, increase that supply, which is going to increase inflation rates, but it's going to save us temporarily from all these issues I just described. So there's really no great solution here. Of course, the more you dig into the everything code, one of the big solutions that we can get into that Raoul Pal talks about is to increase production. And one of the things that he's theorizing is that the increase in production, which will lead to a increase in GDP, one of the main components of gross domestic product, GDP, is your production level. So if your production levels are increasing, this will help to result in increasing your revenue essentially to offset these debt levels. He is theorizing that with the advent of artificial intelligence, that is going to be the saving grace, and that's what's going to lead to us getting out of this mess. We'll have to see. But I hope all this stuff is clicking. You guys have any questions for me? I'm hoping I was able to tie everything here well together. See if there's any other points I wanted to hit on. Oh, this is the last thing I guess Yeah, this is one of the things I guess one of the points I wanted to hit on. I forgot to hit on. One of the other things you want to keep an eye on, this is the other sort of item behind the scenes that you want to pay particular attention to, is something called the repo market. So when you deposit your money into bank, the way the system is lubricated and works behind the scenes in the banking industry, banks lend out to other banks, right? So there's this market called the repo market where banks are lending out to other banks, and it's usually for a very short period of time, and there's an interest rate associated with that. Well, 2019 was a foretelling sign of 2020 because the repo market just froze up. The Federal Reserve had to come in and inject liquidity, print money, to save the markets. So something you're going to want to keep an eye on is the repo market. If you see something troublesome going on in the repo market, where essentially, in layman's terms, banks are hesitant to loan money to one another behind the scenes. It's really the big institutions like JP Morgan. If they're hesitant to want to loan to other banks for very short periods of time and they jack up the interest rates associated with that, what that should intuitively tell you is if JP Morgan is saying, yeah, you can bank XYZ, you can borrow this money from me for the week, but I'm going to charge you like 20% interest. What that's telling you is that there's a lot of fear in the market and they know something about the market that we don't know. And anytime you see interest rates increase like that behind the scenes, again, it's a very big warning sign that there's a lot of fear out there that we could be entering uncertain times, and so they jack up the interest rates. So it's the same thing. It's why, and I didn't hit on this, it's also why you as a consumer and me as a consumer, we should not cheer when there's a drastic drop in interest rates for two reasons. Number one, there's something really bad going on in the economy. Hopefully that resonated with what I just said. If the Federal Reserve did all this work to raise interest rates, to curb spending, and to defeat inflation, if they dramatically decreased interest rates, they're not doing it out of the kindness of their heart or to return to normal levels. They're doing it because they need to ease liquidity and allow money to circulate. And all these negative repercussions with interest rate expenses and commercial real estate loans and the consumer. There's all these reasons as bank failures start to mount up again this year, which will happen, mark my words. That's the reason they'll decrease interest rates. So that's the first reason that you shouldn't be happy about decreasing interest rates. The second is I talked about layoffs. One of the repercussions of this is if they're decreasing interest rates, that means they're seeing an uptick in layoffs. It's already happened. These corporations that are struggling with the increase they're seeing on their commercial real estate loans after they hit that wall of maturity and they have to refinance their loan at higher interest rates. Again, they're going to have to refinance at higher rates. And the only way to offset that, they're not going to be able to raise prices because of inflation. They're going to start laying people off. So obviously none of us want to see that. And the third reason is, don't think for one second, even if you're well capitalized, that as soon as you see a drop in federal funds rates, that all of a sudden the mortgage rates and the car loan rates are going to come down. No. There's something called a risk premium. There is a risk premium that mortgage lenders and car lenders build into the rates. Okay, so right now, let me give you an example. Right now, if the federal funds rate is 5.5%, you might be able to get a mortgage, let's just for simplistic reasons. Let's say you could get a mortgage rate for 7.5%, okay? So there's a 2 percentage point risk premium in there, right? The mortgage, the idea is that the mortgage lender is assuming risk. When you take out a loan, there's a certain level of risk that the mortgage, the institution, the loan company is taking out on your behalf. They're giving you money to buy a home. There's a risk associated with that. And based on your relative riskiness, your credit score, and based on the riskiness of the economical environment, they build a risk premium on top of it. They don't charge you the federal funds rate at 5.5. They charge you a 2 percentage point spread. Okay, that's what it's called, a spread. The difference between what they charge and the real rate of real interest rate is. So they charge 7.5% instead of 5.5%. There's a 2-point spread. Now, as the government starts to drastically decrease interest rates, if this scenario does play out as I believe it will, and let's say all of a sudden the federal funds rate drops to 2%, okay? So it drops from 5.5, let's just say 2.5, make it really easy here. It drops from 5.5 to 2.5. Well, what just happened? The federal funds rate dropped 3%. Does that mean that mortgage rates are going to drop 3% too, and your mortgage rate's going to drop from 7.5 to 4.5? No. Now, why would that not be the case? Why would the mortgage rate stay at 7.5% for a period of time? Well, first off, that would imply a 5 percentage points spread. So for a period of time, you're gonna have the same mortgage rates out there with a higher level of spread, a higher level of risk premium. Why? Nothing about your credit score has changed. The economy has gotten a lot more risky. Layoffs have gone through the roof. Okay? So the overall picture of the economy is a lot less positive. And so in order to cover their own hide, okay, the mortgage companies, they need to increase that risk premium. Now, over time, as the economy settles down, that risk premium will decrease, okay? So we'll come down from 7.5% to 6.5% to 5.5%, and that spread decreases to 3%, 2% again. But there is a lag effect. You're not going to get mortgage rates dropping at the same level that Fed funds rates are dropping, because that risk premium is intended to cover the risk of the economy. And the economy just got a whole hell of a lot riskier. So they're not going to drop mortgage rates. Okay, something to keep in mind why you should not be cheering immediately for an interest rate decrease. What else we got here? Glad to see everybody on the live stream. Guys, if you don't have any other questions, we've been going at this for an hour. I am hungry as anything, and I also did another live stream earlier today. So I'm going to sign off. I hope you learned something from this podcast on interest rates. If you did, feel free to drop the thumbs up button in a comment showing the appreciation. I'll do more of these. And I will be back for the daily TA live stream, All in the Charts, tomorrow. I also, by the way, and it's important you click the bell icon for all notifications to know when I go live. I may experiment with a different time for the live stream this week, so something to keep an eye on. So just make sure you hit that thumbs up. But even if you can't join me live, of course, you can always catch this in syndication and watch it afterwards. Now, tomorrow I will be back around normal time, around 5 o'clock Eastern Standard Time, 5:30. And it will be a TA Q&A. So it'll be all about the charts. But today, again, these personal debt levels, the interest rate expenses, the personal credit card debt levels, the buy now, pay later for the consumer, the conditioning of the consumer, the conditioning of the government, they sort of are linked together in the fact that they're heroin addicts, spending more than they bring in. These things have negative consequences associated with it. And quite honestly, the Federal Reserve is between a rock and a hard place. They either have to, at some point, dramatically decrease interest rates to or near zero, or we're going to have some real shit hit the fan. I mean, it's one or the other. And history would suggest, as we would all like to say in crypto, the money printer go burr. At some point, they will drop interest rates, in my opinion, to near or at zero. And you're going to see a lot of money printing taking place, which will result in more catastrophic inflation for the years to come, which is important why you invest in hard assets, which have outpaced the M2 money supply, which we spoke about last podcast, like crypto, like artificial intelligence, and your tech stocks. So until next time, everybody, let's all spread awareness and let's carry the education forward. Take care, everybody.